You can call the town too. Just call them. They'll do it.
Good morning. We're here with Sarah Bear from Ross Mortgage, and today we're going to be speaking about Mortgages 101. We're actually going to go over what is needed for the mortgage process, questions to ask, how to help your buyers understand the process, and we will be asking questions at the same time. The manual for this can be found in Johnson in the library under the 4-week agent training. Welcome, Sarah.
Thank you for having me. My name is Sarah Bear. As Susan had mentioned, I'm from Ross Mortgage Company. We are your premier partners. If you guys didn't know this, LAER is, there's certain benefits with using Ross Mortgage as your mortgage partner on your end, as well as us having certain benefits for you and what we can provide you. So one of the premier things that we do and we really promote is education for newer agents, existing agents, agents that have been in the business maybe 10, 15 years even, that don't know the new products that are coming on the market. So our goal is to, daily, weekly, monthly, keep you involved with what's changing in the mortgage industry. But really what it goes back to is looking at the basics of what a mortgage is, how important it is for you guys as realtors to understand and to know what goes into a mortgage, and what to expect through the mortgage process. The first step that we have with mortgages is your buyer, right? Your buyer's going to come to you and let you know that they want to buy a house, okay? And your first question should be, do you have a pre-approval? It's always going to be your first question, because the reason for that is if your buyer does not have a pre-approval, they're not ready to buy, okay? So there's two things. When I say the word pre-approval, there's two different levels to a pre-approval. The first level is a prequalification, okay? And if you see this, just following your sheets here, the first kind of paragraph in here is the prequalification. To sum that up, all you need to know is that a pre-qualification is an estimate. It's worth nothing. It's worth nothing that the piece of paper that it's printed on, okay? You'll see a lot of online mortgage companies nowadays that you can get pre-qualified in 5 minutes, in 2 minutes, in 10 minutes. Those are not valid, and that's the first question you need to be asking your borrower, or your buyer in your case, is, okay, buyer A or buyer B, do you have a pre-approval? Oh, yes, I do. And you need to look at that piece of paper, and if it says pre-qualification on there, you need to dig in a little bit more with them. Did you meet with a mortgage loan officer? Did you go over programs with your mortgage loan officer? Did you get your credit pulled? And did you provide documentation? Providing documentation is the key factor in this. If your buyer has said that, no, but I've gone online, I have a great job, I have plenty of money, I have an awesome down payment, it's not going to fly. Because at the end of the day, it's really just a piece of paper and basing off of the information they've put in online. Okay? So what you're going to want to do is make sure that they have a full pre-approval. And what a full pre-approval really is your buyer is providing their income documentation, their pay stubs, their W-2s, their tax returns, bank statements, their license, and anything else that really could trigger what is necessary for a pre-approval, okay? So the main focus for you in the beginning as realtors to take care of your buyers is to make sure that they're fully vetted and fully pre-approved. Number one, for your buyer, we want to make sure that your buyer, if they do fall in love with the home, that they're going to be able to buy it, right? Because you've heard the horror stories where you get to the finish line, oh, something went wrong. It all starts with the basics. It all starts with this initial pre-approval. So on your end, you're going to want to ask those questions. And I would even go a step further to review the pre-approval with your buyer and to give a quick call to that mortgage loan officer If that is somebody other than Ross Mortgage, you're going to really want to dig in a little bit more, okay? Go ahead.
Is that before or after taking them out?
This is going to be before, okay? So you're going to want to make sure that they have a pre-approval, because you're not going to want to waste time if they're not going to be fully pre-approved. Especially if they're saying, I'm pre-approved for $350,000, they verbalize that over the phone, and then you get their letter a week later after you've gone out with them 5 times that it's really $250, and now you've just wasted a week. So the main focus on that is really taking care of everybody in the process from the beginning, right? You want to make sure that your buyer's getting, you're doing the right thing by your buyer as well, okay? With Ross Mortgage, we do fully vet all of our borrowers, all of our buyers up front. And the reason we do this is we're getting back to basics. And that's really what this should be focused upon. So if you see a Ross Mortgage pre-approval, be happy, okay? And if you have a buyer that has a pre-approval or a pre-qualification from another company, you're always going to want to ask them if they've really gone through the pre-approval process, looked at every different option there is out there. There are a lot of mortgages out there nowadays. It's not just one mortgage or 2 mortgage products. There's hundreds of mortgage products. So you want to make sure that your borrower, your buyer, is getting that full information. And that starts not only with us as mortgage professionals taking care of your buyers and your borrowers, but on the other end, in making sure that experience is happy for them and they're getting the full knowledge, because you don't want anything left on the table. Any questions in regards to the differences between the pre-qualification and pre-approval? My question would be...
sample.
You'll see, if you look at the letter, it will say directly on that letter if they're pre-qualified or pre-approved. If it does say they're, pre-qualified, I would definitely, your ears are going to be standing up. So basically, if you have a pre-qualification, dig further.
It's not good enough.
No, it's not good enough nowadays. Especially if you're looking, somebody does want to make an offer, okay? You have educated realtors that know, okay, I'm getting an offer with a pre-qual. Something doesn't line up. And they won't accept that offer if it's not pre-approved. So just something heads up for, the buyers that you're working with. Take this first step. It could save you a lot of time, okay? So moving in now, I said that there's different types of mortgages. We call them mortgage products, okay? There's a lot of new different mortgage products that have come on the market, especially within the last year and a half. You're going to have your traditional mortgages, okay? Plain, Jane, vanilla mortgage is called a conventional mortgage, okay? These conventional mortgages are, minimum down payment could be between 3 and 5%, okay? You see a conventional mortgage, there's really not much on your end that you're going to need to worry about, okay? Because you know that it's pretty standard. They probably have really good credit, a good down payment. You can feel pretty confident about that conventional mortgage, right? Again, because you've already gone back to this mortgage loan officer and asked them about their pre-approval and how they've, gotten to where they've gotten. But it goes into in all of this content here. The first thing that we're looking at is fixed versus adjustable rates. On your end, as far as realtors, there's really not much that you need to get into with that. Adjustable rates have a bad rap. Depends on who the person is. So if you see an adjustable rate versus a fixed rate, there's really no need to worry on your end. I would almost overlook it. Might be something to just talk with the borrower about. Are you comfortable with the adjustable rate? Yeah, I've gone through with my mortgage loan officer. It makes sense for me. It's a good fit. It's a good fit for some people. Next paragraph down is the government versus insured loans. Government insured versus conventional loans. That's, again, not something that you're going to necessarily need to focus on your end as a realtor. Your job is really to find somebody that perfect home, okay? If we're looking at the government versus conventional loans, in my opinion, that's something that you can just kind of take right out of your head. You don't even need to worry about that. It's good to know the differences of them, but realistically, on your end, when you're making an offer, when you're finding this dream home, there's not much that you're going to have to be concerned with. Let's get into the different types of loans. So these are the basic types of loans. FHA loans. Who has heard of FHA loans? Who thinks they're the redheaded stepchilds of the group? Okay. I agree that there has been some connotation out there that FHA loans are not the best loans. However, they are an unbelievable loan for the right person. Okay? There's pros, there's cons. The biggest pro is that it creates more buying power for the individual borrower, for the individual buyer. So somebody that could say maybe only afford, $300,000 or $200,000 with a regular standard conventional loan, as we're going back to, with good credit and whatnot. Well, maybe they want to be somewhere up around, $250,000, $275,000. Maybe this market is pushing them to have to be around that $250,000, $275,000. Well, guess what? An FHA loan is going to allow you more purchasing power. Okay? So that's one of the great things that FHA does. The second thing that FHA does is it allows you to put down a low down payment, 3.5%. Okay? That's pretty good. It's not, it's not the best out there, but what it does, coupled with that high purchasing power, it's really giving you a tier up, a level up. So we got the 3.5% down, the more purchasing power. The third great thing is that if your credit score is in the low 600s, even up into below 7, right on the border of 700, maybe even a little bit higher, you're going to have to pay private mortgage insurance with any loan that you put less than 20% down on. Okay, anyways. But if we're looking at an FHA loan, they have a fixed private mortgage insurance premium per month.
Can you explain what private mortgage insurance is?
So private mortgage insurance is basically a protection for the government, a protection for the lender, that is stating that, okay, you're not putting down what is perceived as a comfortable amount of a down payment, which in today's age, it's 20%, and that really hasn't changed much, okay? So that 20% down payment is the sweet spot. If you put down the 20% down, you get rid of the private mortgage insurance, which is a monthly insurance that's basically insuring your mortgage loan. The money that we're lending to you, you're paying a monthly insurance on because you're considered a higher risk. Okay? In today's day and age, do a lot of people have private mortgage insurance? Yes. Are there ways around private mortgage insurance? Yes. Even without the 20% down, there's different programs out there that can be split. There's a lot of creative things that if you have a mortgage loan officer that really knows the ins and outs of how to get around that, the different products that are out there now, there's certainly ways to buy a home with less than 20% down and have no private mortgage insurance. So it's always a great question to ask when you have a buyer, hey, I noticed, you have a conventional loan or this type of loan. By chance, are you paying private mortgage insurance? Just want to make sure you're getting in the best mortgage that you can be getting in, okay? Because there's a lot of options out there to get rid of that. Private mortgage insurance with some different mortgage products are based upon your credit. Some could be based upon your income. And that will change. So if your credit is, in the lower 600s to the mid 600s, maybe FHA is the way to look because that private mortgage insurance is a fixed payment. It's not on a sliding scale or different tiers.
Sir, let me ask before I forget. With what you just said about private mortgage insurance and the fixed rate, is it relative to how much you borrow though, or it's just flat?
It's just flat. So for in the most traditional sense with an FHA mortgage, okay, if we're gonna really kind of get into this a little bit further, but I'll break it down. So say you borrowed $100,000, okay? Your private mortgage insurance per month is going to be 0.85. So whether you borrow 100,000, 200, 300, is going to be 0.85. Okay, if you do a 30-year fixed FHA. So that means $85 a month if you're borrowing, you know, 100,000. Now let's look at it differently. If somebody had the same credit score and was in a conventional product, and you're looking at $100,000 and their credit score was about 660 or below, you're looking at 1.24%. Roughly around that area. It's going to change with different private mortgage insurance carriers, but you're looking at a difference of now from $85 now to $125. And that's just an example out of $100,000. Think about if you're going up to $300,000. You know, that's a major swing in your monthly payment. So that's why I say with FHA, don't discount it. Even on the end where, you know, you're the listing agent. You know, and we'll get into a little bit more with the FHA and the different types of the ins and outs with the appraisal on the FHA, because I know that's a big question that realtors do have, and I know that's why a lot of realtors are scared of FHA mortgages.
So it's really depending on the higher lender?
On the
lender, the FHA loan.
Mm-hmm.
So let's say I qualify.
Yeah.
And I have low 600.
Mm-hmm.
And how do we get away with not paying the
PMI? So good question and great segue into the cons of an FHA mortgage. Okay? The cons of the FHA mortgage is that your private mortgage insurance, there's no way around that. With other programs, you can get rid of the PMI maybe by getting creative or looking into different, you know, programs. With FHA, you will always have private mortgage insurance, okay? Even when you've paid it down to $10,000, you're always going to have private mortgage insurance, okay? So statistically, though, what we're looking at is how long are you going to be in the home? Okay. What's your plan for the next 2 to 5 years from today? Are you going to stay in this FHA mortgage? Traditionally, people don't stay in an FHA mortgage more than 5 years, 10 years max. Anything out of that, you're usually refinancing. Life events happen. So it's, you know, a great way to get into the house with a low down payment, the house that you want, a fixed private mortgage insurance, but you don't want this to be your lifeline for a mortgage. You don't want to keep this forever, okay? But it's a really convenient way to get what you want to start, okay? The other con, and I'm not even sure, you know, I say con, but I'm not knocking FHA loans because I kind of love them, is that there is an extra closing costs, okay? So there's a mortgage insurance premium that is paid up front at the time of closing, okay? Now this is 1.75%. So it's a pretty hefty number. If you're really, you know, if you're somewhere around 100,000, like I said, it's not going to make or break it, but if now you're looking up at 300, 400, that's a big number, okay? The one benefit of that, though, is that it's the only closing cost that you can actually roll into your mortgage, okay? It doesn't happen often, okay? Closing costs, you know, as a buyer, you have to come up with your down payment, and you have to come up with your closing costs. That's what you're responsible for as a buyer, okay? But this extra closing cost that's attached to this FHA mortgage, you can actually finance that in. Okay.
So you don't need a binder, an extra binder.
Nope. So it can be just rolled in and added onto your loan amount. For right now, that is tax deductible. Not sure how long that's going to last, but you know, so it's something to be cautious of. You know, it's something to look out for. Yeah. So, you know, any questions on FHA mortgages as far as that
Yeah, let me
stands right now?
add, Susan, something before we go on. So why don't you like FHA loan?
Oh, I didn't say that.
No, but I mean, I know generally they say that the real estate agents don't like it.
Agents don't. I'll
reason?
answer that. Agents don't like it because
You don't care?
No.
Oh, okay.
No.
All right.
a lot of agents
She's
don't like
seasoned.
it because it has it's changed over the years. The FHA loan has changed over the years. Okay, so seasoned realtors who started off with FHA loans that didn't have private mortgage insurance that lasted forever, didn't have all these appraisal kind of extra add-ons with the FHA. Now that these have been added on for the buyer's protection, it sometimes could cause issues with